Assalamu alaikum friends. This is part 3 of IFRS 9. So today we are going to discuss financial assets, and trust me, this is one of the smallest because only this much is there. Whatever you can see on the screen, only that much is there for financial asset. Yes, you'll be very shocked because you'll be thinking a financial liability or compound instrument was that big. What about financial asset? It might be even bigger. No, it's not. Okay. So let us go through some examples of this principle and also the definition of it. So IFRS 9 says that an entity should recognize a financial asset when and only when an entity becomes party to the contractual provisions of the instrument. When and only when the entity becomes party to the contractual provisions of the instrument. Let us see some examples if you're not understanding the definition. 3 examples are there. A trading commitment to buy or sell goods is not recognized until one party has fulfilled its part of the contract. What does it mean? We'll break this one by one and we'll try to understand this. Let's say you have a contract to buy a good or even sell a good, in both ways, buy or sell. Okay, it cannot be recognized until one party has fulfilled its part of the contract. At least one of you or either the other party should fulfill their part. One party should fulfill their part in the contract. Until then you cannot recognize it, whether it's a sale or purchase. Okay, so a trading commitment to buy or sell is not recognized until one party has fulfilled its part of the contract. At least one of you should fulfill your part. For example, a sales order will not be recognized as revenue and a receivable until the goods have been delivered. Example is given here. Let's say you have given a sale order. You cannot recognize it as a revenue until the goods have been delivered. As a revenue and a receivable until the goods have been delivered. The goods should have been delivered to your customer. Then only you can recognize that sales order as a revenue. Until then you cannot recognize. Okay? Why receivable? Because yesterday we have explained when I was explaining you financial assets. Okay, or under IS 32 when I was giving the definition of financial assets, I told some examples of financial asset was given. One of it was receivable because you have a contractual right to receive cash. So that receivable, when can you recognize it? Receivable is a part of financial asset only when you have delivered your goods to customer. Okay, so in short, just remember, when you deliver the goods to your customer, you can receive receivable. That is an example of financial asset. Just remember it like that. That means at least you have fulfilled your contract. It does not matter whether your customer has paid you or not in cash. Okay, but you have paid, you have transferred the good to your customer, so you have fulfilled your part of the contract. That's why you can receive, you can recognize it. Receivable is a financial asset. Okay, that is the first example. Second example, they're talking about the forward contract. We know forward contract is a derivative. Okay, it is accounted for as a derivative financial asset and are recognized on the commitment date, not on the date when the item under the contract is transferred from seller to buyer. This is a bit different. This is recognized on the commitment date, not on the date when the item under the contract is transferred from buyer seller. This is not like the first example. First example, what did we do? We transferred the good to customer and we recognize receivable. Second, we have to transfer the good also. They also have to pay us in cash. Then only we can recognize. It's like commitment has to be fulfilled from both the side to recognize it. But what type of good is the second one? For the derivative financial asset. First one was receivable. It was simple. You deliver goods to customer, whether customer pay or not, you receive receivable. You recognize receivable. Second, for derivative, okay? For example, forward contract, forward future options. These are examples of derivative, right? In financial management, you must have gone through it, or even AFM. So these are known as derivative. So for derivative financial asset, commitment has to be fulfilled. It does not matter whether it's not like receivable. You have to transfer the good also, you have to receive the cash also. Okay, it is recognized on the commitment date when you have committed. Okay, so for Derivative financial asset, that is the how you recognize financial assets, because financial assets there could be derivative financial assets also. It's not always that it's not a derivative. Receivable is not a derivative, but the second one is a derivative financial asset. Okay. Third example, option contract. Okay, this is about forward contract, specifically relating to forward contract. Now let us go to the option contract. Option contract is also derivative, isn't it? That is also derivative financial asset, same like forward, but the difference is it is recognized on the day the contract is entered into. So if you see, all the three are examples of financial assets, but the way you recognize these three are different. Okay, this is what? This is receivable. Okay. So receivable you recognize when goods have been delivered. Forward contract you recognize when, on the commitment date. Option contract you recognize when on the date the contract is entered into. So the day you enter in the contract, you recognize it. It does not matter whether it's fulfilled or not, because option, we know option is a right. You might fulfill, you might not fulfill. It's your option. You can even let it lapse. You might not commit to it. That's why option is recognized on the day the contract is entered into, not on the date when the item subject to the option is acquired. So I think financial asset is one of the easiest thing for you to remember and memorize also. Only three things you need to memorize: receivable, forward contract, option contract, and the date that it is recognized are different. Okay. Now, these three examples I'm going to linking to the definition. Now let us go through the definition and see whether you can now understand the definition or not. IFRS 9 says that an entity should recognize a financial asset when and only when the entity becomes party to the contractual provisions of the instrument. So under all these three conditions, the day when they become a party to the contractual provisions, that means they have a right, contractual, they are contractually obliged to pay or receive in the contract, then only they can recognize financial asset. For example, the first one, receivable. When you have delivered the good to your customer, aren't you contractually now obliged to receive cash from your customer? You are, right? Contractually, under the contract, now you have the right to receive the cash from your customer once you have delivered the goods. So that's why under the first one, it satisfies the definition that you become a party to the contractual provisions. Second, forward contract. Recognize on the commitment date when you have committed. Then also you are a party to the contractual provisions. Third option, when you have entered into the contract, okay, then also you are a party to the contractual provisions. Because when you have entered on the contract, it does not matter what happens at the end. You will receive, you will receive cash. You are receiving a premium, no? When you enter into the option, so that cash you are contractually, you have that right to receive that cash. Same for the forward also. On the commitment date, you have the right to receive the cash. For receivable also, you have the right to receive the cash from your customer. In the future date, it does not matter when you receive, but you have the right. Contractual right is there. That's and that is when you recognize your financial asset, when that contractual right is there. So under all the three conditions, that right has been there. So that's why you recognize financial asset. Okay. Now, since we have time and I finished this less than 10 minutes, so I'm going to cover all the test your understanding I'm going to cover. Okay. Test your understanding 2 and 3, because 1 and 4 I have done. So we'll go through test understanding 2 and 3 before I actually go to the next topic, which is equity instruments, and it's big enough. Okay, so this is my plan, that wherever I see that my videos are shorter, I'm not taking so much of time, maybe the concept is small, I'm going to put test your understanding questions in that, and I'm going to cover it up. So now let us start with test your understanding 2. Test your understanding 2, HOI. So HOI raised finance on 1st of January 2001 by the issue of 2-year 2% bond with a nominal value of 100,000. Okay, issue of 2-year 2% bond with a nominal value of 10,000. It was issued at a discount of 5% and is redeemable at premium of 1,075. Issue cost can be ignored. The bond has an effective rate of interest 10%. Wiggins raised finance by issuing. Wiggins raised finance. Okay, this is another company. He raised finance by issuing 20,000. 6% 4-year loan notes on 1st of January 2004. The loan notes were issued at a discount of 10%. Redeemed after 4 years at a premium of this one. Effective rate of interest is 12%. Issue cost. Here they have given you the issue cost. Okay. Cavendish raised finance by issuing zero coupon bond. Zero coupon bond. Cavendish at a par on 1st of January 2005. Nominal value is 10,000. Bond redeemed after 2 years at a premium of this. So everything is redeemed at premium only. Issue cost is ignored. Effective rate of interest is 7%. Reporting date is 31st December for all the three entities. You have to deal with all the three entities. Now, illustrate and explain how this financial instrument should be accounted for by each company. We'll see. So, starting with HOI. Okay. Each company needs to be dealt separately. So, first we are going to do with HOI. So HOI has a financial liability to be measured at amortized cost. We know that financial liability we measure at amortized cost. Okay. So the financial liability is initially recorded at fair value of consideration. See, you have to know initially it is measured at what? Okay. When we went through financial liability, okay, you can go back and check my financial liability video where I've discussed that initially it is recorded at fair value of consideration received, the net proceeds of issue. All the issue costs you have to deduct. Okay. The fair value of consideration received. Net proceeds of issue, that means minus all your issue cost initially recognized at later you measure at amortized cost or fair value through profit and loss. So this amount is then increased each year by effect. So this amount, that carrying amount, okay, increased each year by the interest at the effective rate and reduced by the actual repayments. So now HO has no issue cost, that means nothing to deduct. So the net proceed is 9,500. How? You have 10,000 nominal value for HOI. You issued them at a discount of 5%. So that discount needs to be deducted. You have to deduct issue cost of issue and also discount. There will be cost of discount also. But there is no issue cost. So you only have to minus the discount, the 5% discount. Okay. So 5% of 10,000 you minus from 10,000 and you'll be getting 9,500. Okay. Now the annual cash payment. You need to find the annual cash payment. Remember, before this table, you have to do calculate this working separately and keep it somewhere. Okay. The annual cash payment is 200. How? 2% coupon rate multiplied by 10,000 nominal value of the debt. This 2% coupon rate which is given to you, you take at the nominal value, not on 9,500, on 10,000 before you deduct the discount. Okay, always is like that. Cash payment, whenever you have to calculate on the nominal value only, you take the coupon percentage. What is the coupon percentage? It is 2% here, 2% bond. So that 2% is a coupon rate. They will not say you it's coupon rate and all, but it's given, right? It is given like this only. That's the coupon rate. So now what else? For 2 years. So for 2 years you have to do 31st December 2001, 31st December 2002. Okay. So you start with balance brought forward. Okay. Which balance? This 9,500 only. Okay. Then from there you take 10%. The effective rate of interest you take, not the coupon rate. Coupon rate is this 200. Okay. Coupon rate is same for the first 2 years, 200 and 200. Then you get this balance. Then this balance becomes the opening balance for the next year. Again you take 10% on that, minus 200. Okay. So if you add this to finance cost, that is interest which will go in the P&L. It is this amount. Okay. And when you take this, what is the total? we need to understand what is this 11075. Just give me a minute. Okay, it is this amount only. 10 to 50 plus 1025 minus 200. This was supposed to be written here. Okay, but they didn't have space, so they wrote it down. Okay, this was supposed to be written here, this blank space, but it's written down. It came in the next line. That's why there's a confusion for that. Now let us go to the second company. Okay, so you recognize it like this. First you need to define whether it's a financial liability, financial asset, or a equity. Then only you can measure any financial instrument. In IFRS 9, if you have been given anything, you first need to see what is it. Next is vegan. He also has a liability, and same we are using amortized cost. So initially same, fair value less transaction cost. Transaction cost means all your issue cost, discount cost, and all. So here, what are we going to do? What is the cash received? Here we have a transaction cost. Okay, 1000 was the transaction cost, and cash received was 20,000 into 90% because 10% discount. Okay, so 10% discount, you are taking this one. So you deduct, and this is the on this is your opening balance. You start your 17,000. Okay, and this is for 4 years. It will be redeemable for 4 years. That means you have to take 2004, 5, 6, and 7. Okay, read this line. Effective rate is used to determine the finance cost. So effective you use to find the finance cost, which will be in the P&L. But the coupon, you take it in the nominal value, multiply by coupon by the nominal and find the cash paid. Okay, so you start with 17,000, apply 12%, which is effective rate. Again, cash paid will be 1,200. Okay, how 1,200? What is the coupon rate? See, coupon rate is 6%. Okay, on 6% on which, what is the nominal value? It is on 20,000. So 6% on 20,000 is 1,200, which will remain fixed. That is your cash payment. Okay, so 1,200 for all the 4 years. Only your finance cost will change because that 12% interest on the balance brought forward. So balance brought forward changes every year. This changes. So then this opening becomes this closing again. Take 12% and then minus 1,200. Then this closing balance becomes opening balance of this. Right? It keeps on repeating. So same how you have done for this one. Now let us come to the last company, Cavendish. He also has a financial liability measured at amortized cost. Same. Initially fair value minus transaction cost. Okay, so there is no discount on issue. Now there is an issue cost, so nothing to be deducted. No discount. How will you know whether it is discount or not? They will say issue at par. Okay, we'll see the wording. This was zero coupon bond at par. Zero coupon bond means no interest, no cash payment. No, at par means they will tell you whether it is issued at premium or discount. At par means no discount, no premium. Okay, so there is no change. So what do you have to do? Only the effective rate you have to, it will be increased, the opening balance. That's it. There are no interest payments also in this example because it is a zero rated bond. Remember, when there is no coupon or zero rated, it's the same thing. There will be no interest payment, no cash paid. Okay, so opening balance will be 10,000. On that you pay 7%. Cash payment is nil, so 10,700. This 10,700 you brought forward, apply 7% on it. Then this plus this, it will be 11,449. Okay, so 11,449 you need to minus this cash payment. You need to minus this, the total of this with this one, so that at the end, always remember, balance carried forward at the end should always be zero. If you have some difference, sometimes what happens is you might have to round up figure. So when you're using rounded up figure, you might have small different decimal places like 0.1, 0.2. That does not matter. Okay, in the exam, but it is understood by the examiner that due to some rounding differences you are having some 0 point something, but it, if you take the whole number, it will be zero always. Okay, even for this one also, if you see. That's why cash payment at the end you are deducting this. I'm sorry, it's you are deducting the total of this with this. Here also you have to get 0. Check this by yourself. Are you getting 0 here also? This is cash paid only, which you need to divide minus from this. It will be 0. All the three. So if you see, this is how you value financial liability. You measure. Okay. Test understanding 2 is on the measurement of financial liability for all the three companies. Now let us go to test understanding 3. It's a small question. So been regularly investing assets that are measured fair value through profit and loss. It is at asset and it is fair value through profit and loss. Now it's the next question. Earlier one we were using amortized cost to measure liability. Now we are using fair value through profit and loss. So this asset purchases are funded by issuing bonds. If the bonds were not redeemed at fair value, an accounting mismatch would arise. Therefore, Ben decides the bond to be measured at fair value through profit and loss. The fair value of the bond fell by 30 during the reporting period, of which 10 million relate to their credit worthiness. How should the bonds be accounted for? It's a very good question. If you have understanding, you have a sound understanding, you grasped the understanding behind this, each question will be easy for you in financial instruments. So this is the answer. I told you answer is very short. This is financial liability when it is designated at fair value through profit and loss. Okay. It should be designated at fair value through profit and loss only to reduce an accounting mismatch. Okay. And that fair value movement must be split into two things. We have mentioned it, OCI and profit and loss account. How do you measure it in OCI? First OCI, then balance is profit and loss account. Fair value movement due to own credit risk. If the fair value movement is due to own credit risk, which is presented, okay, that should be presented in OCI. The remaining fair value movement is presented in profit and loss. Okay, so now we'll go explain this through figure, because I know that you people are good when I explain this through numbers rather than explaining through words. So the value of Bin's liability will be reduced by 30. A credit of 10 million will be recorded in OCI and credit of 20 will be recorded in this one. What is the fall in value of fair liability? Fair value? It is 30. But out of 30, 10 is relating to credit worthiness. So that means 10 will go in OCI, the balance 20 will go in profit and loss account. Okay. 10 will be recorded in OCI, 20 will be recorded in profit and loss. Hence the total 30. Okay. Because it is relating to the credit of the company. The credit worthiness reduced. So that's why fair value fell by 10 million. So that will go to OCI, balance 20, profit and loss account. Okay. So that's it. Until we have covered until financial assets. So until that, all the test your understanding, there are 4 test your understanding, all 4 I have covered. Okay. So the next topic will be equity instruments. Okay. So see you then. Till then, take care. And make sure that you practice all those questions by yourself. Okay. 4, 5, 6 times, does not matter how many times you want to practice until you get it perfect. Make sure that you understand the logic also, not just memorizing answers. Okay. So best of luck.